Right, afternoon everyone, just giving you a quick wave hello. This is our LCG webinar on candlestick charts, and then more importantly within that, candlestick patterns and how to use those in trading. You know, it's a half an hour webinar, probably might extend a bit beyond that at the end as we look through some example charts. Half an hour should be the kind of core of it. If some of you have to skip off for lunch, if you do have time, obviously watch the rest of it, and we will be recording this, so it will be available on YouTube to watch afterwards as well. It's a big topic, candlesticks, so really probably scratching the surface if I'm honest here, but hopefully it's the key information that you can use as a bit of a building block, and if you already use candlesticks, just as a refresher on what you're currently doing, maybe give you a different take on things and why you're doing it. So I'll sign off and we'll head over to the presentation. And obviously, if you have any questions at any point, fire them through to me, and I'll be happy to answer those. So the topics we're covering today. What are candlestick charts? The very basics of what we're actually looking at here. How do they work? The advantages over other chart types. Obviously, we're focusing on candlestick charts today. It just happens to be, in my experience, the most popular charting type for day traders. But obviously, there's other charts as well. The best known candlestick patterns, again, you know, we only got limited time today, so I'm choosing the ones that, in my experience, are the most useful to use, but obviously there is a really wide gambit of patterns out there, and you know, that's probably some of those more exotic patterns, if you like. Maybe that's a source for a future webinar, but not today. And then we're just going to go through some current price charts. So if there were some particular charts that you wanted me to take a look at, you know, tell me at the end or tell me now. You know, chuck it into the questions box. Some particular markets that you're interested in, or some patterns that you'd seen and you wanted to ask about, then yeah, certainly let me know. Just send it through there and I'll cover those charts you wanted to have a look at. So ultimately, what is the candlestick chart? Why are we using it? Well, it's a way to demonstrate price movement over a period of time. Obviously, if you have a 1 minute candle, that candle is displaying, it's a summary of what the price did over that 1 minute time frame. Now if you have a 1 minute chart but it's got 100 candles on it, obviously each one of those candles is giving you some sort of demonstration of how the price moved over that period of time. And obviously that's important in the context of technical analysis, because we're using that information on past prices to give us some indication what's going to happen for future prices. Now, I say it's a summary because it's not looking at every tick change in the price. The price obviously fluctuates constantly, particularly in these super liquid markets that LCG trades. It's only showing you, in fact, the opening price, the closing price, the high price, and the low price. And so you'll see on the right-hand side here, these are all the time frames that LCG offers. You know, less than a minute, you're getting into sort of, you know, trading algorithm territory where a human really doesn't even need to be looking at chart anyway. And beyond a monthly, which will how, you know, we're looking at sort of Warren Buffett type time frames here. Not really something we're going to be particularly doing on a day trading basis, looking at on a day trading basis. But the idea is that these candles can be applied to all these different time frames. So whatever kind of trader you choose to be, a day trader places 100 trades a day, a position trader that places you know, a handful of trades a year, you know, you can still apply these same techniques. So how do they work? You know, what is it we're looking at when we're looking at a candle? Now you notice that basically the information displayed on a candle chart and a bar chart is basically the same. Also the high, low, open and close. Now the candlestick chart shows it a bit more visually. So you have this real body as described in this picture here, and so On our charts, on LCG charts by default, there'll be green and red, and so that green body will be a period of time in which the price has risen. So it closed at a higher price than it opened, and the red will be the opposite. Now you can also get the other sort of maybe classic candlestick chart coloring would be a clear candle for a rising time period, and then a black colored candle for a falling candle period. So white, or maybe even just clear for the rising, black for the down one, the black, or filled for the downward one is the kind of general logic. So it makes it very easy to see that on a green day, you know, that over that period of time, you know, price closed higher than it. I'm just looking at this picture here, which I borrowed off another video, and seeing that actually for some reason the open is at the top and the close. They both got the same, but actually what it should be saying here, I've only just noticed this, is really the open should be down here, the close should be up here. And this red candle is in fact correct, where it opens up here, but then it closes down here. And then we've got these shadows, sometimes called wicks of the candle, which are the extra bit of information beyond the open and close that show the high and the low of the day. So you notice that the main kind of difference, I suppose, between the candlestick and the bar chart is that the candlestick puts extra emphasis on the open and the close. Now I actually like that because ultimately I think, you know, what you can do lots of things within that time period, but ultimately, you know, what you have done by the end of the period, that's a measure of your real intention as a trader. So the market may go very high during the day, but ultimately if it closes down, you know, even if people have got a bit excited during the day, if it got closed lower, you know, ultimately they're obviously feeling a bit pessimistic, hence the prices close lower. So I mentioned there are different chart types. There are all sorts of charts, you know, Heineken Ashi charts, and you know, various completely different fangled versions of a candlestick chart. I'm just sticking to the kind of three simple ones here. So in my opinion, you know, I would say probably candlesticks are the most versatile, hence I use them the most. Probably the best for day trading, but each chart type is useful in different scenarios. So line charts I tend to use mostly when I'm looking at a longer time frame. So it's more about kind of identifying the trend over a longer period of time than it is trying to spot entry points. And so in that case, you know, a line chart can get rid of a lot of the noise. It really simplifies it. And normally a line chart's only showing the closing price. So again, going another level from the candlestick chart, which emphasizes the open and the close, this is just showing you the close, doesn't show you that intraday fluctuation. And it's good for when you're comparing the performance of multiple securities, multiple assets. In this case, we just showed those big three US tech firms that, you know, just how they did over the first 5 years of their existence as a public company, which is quite an interesting thing to do. And obviously you can just compare the performance of different currencies, different commodities over time. And if it was a candlestick chart, it just might be a bit too busy. So that's why I like line charts in that scenario. Bar charts are the most traditionally used in Western financial markets. Candlestick charts are obviously, the full title is Japanese candlestick charts. They're imported from Japan, obviously. I think, again, they're good if you're just trying to identify the overall trend, slightly less distracting than candlesticks, because, again, you're not seeing that thick body. You're just kind of seeing the kind of line with the two ticks either side showing the open and the close. But it does give more information, does show that intraday action, which a line chart doesn't. Then candlestick charts, I figured I'd chuck this little chart that I put on Twitter yesterday. Obviously we've had snap results overnight, the shares are down about 15% after hours. So yeah, we said in a special report that things have not been looking good since it hit the IPO price again for the second time. So you see the kind of the price tanked obviously since the IPO, rebounded a bit recently, but hit that IPO price, all the initial investors just sold off again, and now we're below this rising trend line, so yeah, you can kind of pick out a bit of what's going on using a candles chart sometimes. I would just say that the candlestick chart is visually more appealing, and obviously, as we're about to get to, makes it easier to spot the patterns. So moving on to those patterns. These are the candle patterns that I look at to find evidence of indecision in the market. So an indecision doesn't necessarily imply a reversal. It just shows a period in which maybe in this instance on the first chart, bulls really had the run of things, but then where the price is closing right near the top of the period, but then you reach one where actually the price kind of just closes in the middle of the period. So it runs up a bit, runs down a bit, closes in the middle, and so that can just be lead to a kind of period of pause where maybe there's a little correction then a bounce, or it could actually be a reverse as it demonstrates in this scenario. So this particular example where you actually have a body in the middle is the spinning top. But the more extreme version of that is the doji, where actually it opens and closes right at the same price level. And so whereas these two doji patterns, the traditional doji and then the long-legged doji, are both kind of extreme examples of indecision in the market, a sort of buyers and sellers perfectly even, if you like. The dragonfly doji at the end of a trend is actually quite a strong bullish reversal, and the gravestone doji at the end of a long uptrend is actually quite a strong bearish reversal pattern. But just in the middle of a trend, more like a indecision point. So these are worth noting before I move on from indecision. These are worth noting not necessarily as direct triggers to trade, but more as to give you a feeling as to how the trend is developing, and for you to kind of reassess whether you are still confident in your initial trade decision to hold on to the trade that you're in, or whether to get into a trade that you were debating. Now again, there's quite a few of these continuation patterns, but I just wanted to focus on a very kind of basic one, which is well, I'm probably going to butcher the name, but the Marubozu. Don't know, anyone else want to try and phonetically spell that, how they would pronounce that? But it's yeah, let's not dwell on it too much. But the idea being that the price opens right at the low and doesn't basically opens and just doesn't drop throughout the session, in the case of this bullish example, and closes right on the high. So price just basically never went down throughout the entire session. It's obviously a very confident looking candle, and the opposite for the bearish, where it opens and basically doesn't even go higher than that, and just drops all the way into the close, and it closes right on the low. So it's basically an indication that if there were rising prices before the bullish Marubozu, then there's a good chance that that uptrend will continue, and just vice versa for the bearish, good chance that that bearish trend continues when you see that candle pattern. So again, not necessarily a trigger to enter a trade, although it can be in the case of a breakout of a consolidation. For example, say we had a bit of a pullback. There's a bullish trend, had a bit of a pullback. Maybe it's going to be a top, but actually we see this big bullish example pushing us right through the high. It's basically a breakout, and maybe that actually could be a trigger to enter a trade. Same in this example, bearish trend, bit of a pullback higher, then suddenly you whack it down through. You have the big bearish pattern showing a continuation of the trend, and you have a breakout through the prior low, maybe those two factors combined give you the confidence to re-enter that bearish trend. So perhaps adding to a position you're already short in that example, or just getting in for the first time. So these can be, even though people mostly focus on the reversal patterns, and I would say the reversal patterns are probably the most important, these are well worth taking attention to. So onto those reversal patterns, certainly ones that I look out for the most probably are the engulfing patterns. This is it just involves two candlesticks, and it's where the bearish pattern, the second candlestick engulfs the prior one. So the body of the second candlestick is what it's all about. That has to engulf the previous body. So you'll notice in this example that actually the high of the second candle is not above the high of the first candle. It's ideal if it is. It's a more solid pattern if the high is above. But it doesn't have to be by definition. But the close in the second candlestick has to be basically below in the bearish example, and it has to be well above in the case of a bullish example. And basically, the more candles a candle engulfs, so in this example there's just one candle on the left, but actually you could say that this also engulfs this third candle here. So this is a particularly strong pattern because it engulfs not just that one, probably another candle that's hidden by this bar, and then another one there. It's actually engulfing three, makes it a stronger pattern. And the fact that it's closed well up above those previous closing prices and opening prices, basically well above those previous bodies, makes it a strong pattern. What makes it a slightly weaker pattern is when it kind of closes off the lows here. So that surge of optimism, but then dies down a bit by the high. That to some extent is to be expected if it's a very large candle. It's always going to come off the highs a bit as people sell towards the end of the period. So the idea of this candlestick basically is that it was, there's a small example at the top here, then a bigger example midway through, but basically the idea is that the price had been trending higher, but then you get this overwhelming change in sentiment where price tried to push higher and actually end up closing well below the previous day's low. So whereas buyers were in control, sellers take over. That's the idea of what's going on behind this pattern and why it actually has some significance. These are another key ones, got lots of different names if you're kind of researching online and things. Pin bar is as a name that comes up a lot as well, but in the case of candlesticks, this example at the end of an uptrend is called a shooting star. You can have a variation of that as well, which this to some extent is an evening star, where you have a rising candle on the left and then a falling candle on the right. So all those three together makes an evening star, but just the long wick and ideally a lower close on the shooting star pattern makes it strong. So it's basically a very small body with a very long wick. And the idea here being that, yes, again, we're in an uptrend, sentiment is really strong, pushed the prices right up, but then midway through the period, sellers completely took over, piled in with a bunch of sell orders, buyers lost confidence, and we ended up closing the period lower. So it's showing that shift in feelings, in sentiment in the market. The inverted hammer is not as reliable in my opinion, and it makes sense because it's just less intuitive, but nonetheless it is something to look out for. It's an extreme looking candlestick where obviously prices try to push well higher in the context of a downtrend, which was a bit of a shock. Still sellers came in and sold the period much lower, but it's a sign that buyers had some confidence, which they shouldn't do in the case of a falling market, right? Buyers have the confidence in a rising market. And then the hammer is the kind of bullish example of the bullish version of the shooting star, where again we're going to downtrend, prices push right down to the lows, but then close right up near the high. So it can be a red candle, but it's more a stronger pattern if it's a green candle in the case of a hammer, and the smaller the body the better, the longer the wick the better. And then again, hanging man, kind of the opposite of the inverted hammer. So why do these patterns work? Firstly, just like every technical indicator, they don't work every time, far from it. But in my opinion, they just work enough. They offer you some sort of edge beyond just pure random price movement. There's a certain logic behind these patterns, and they do reoccur, and when used in conjunction with other technical analysis, can offer you a much better clue than random, in my opinion, of where the market could head next. So what is actually going on behind it? We touched on it a little bit with each individual pattern, but it basically, again, comes down to thinking about buyers and sellers and their psychology. Candles compare how these buyers and sellers feel at the beginning versus the end of a time period. So in the case of these indecision patterns, buyers and sellers are pretty unsure, so hence, you know, they very much, no one party really dominates the other. In the case of a bullish continuation pattern, buyers continue to feel bullish. In the case of a bearish continuation, sellers continue to feel bearish. It's a continuation of the status quo. It's a continuation of the trend. You know, in an uptrend, when you see a bullish continuation pattern, it's the buyers were in control and they remain in control by the end of the period. In the case of reversal, obviously, as the name implies, it's the feelings are getting reversed between the buyers and sellers. While buyers were feeling confident and in control, the reversal pattern indicates that actually they're losing control, they're getting less confident, and likewise, in the case of a bearish reversal pattern, those sellers are gaining confidence, getting more bearish. And yeah, and it's exactly the same thing for the bullish reversal pattern. You know, the feelings have been reversed after a downtrend. Suddenly there's a candle pattern where you see buyers really re-emerging, taking control, feeling more confident, pushing the price higher in a very clear way that can be seen, not just a little tick higher throughout the period, but then eventually closes the day lower. This is not a transitory feeling. This is something more solid that you see in the close of the day through the body of the candlestick. So that, for me, is the kind of real crux of actually what it's all about. So now I just wanted to try and go through the trading platform and just look at a few examples. Now, is there any particular markets that anyone wanted me to cover? Anything that they trade on a daily basis? I've got a little something prepared, so don't worry if not. But obviously, I'm happy to have a look at whatever you guys are looking at. I'm glad you said that, Adam. Actually, dollar yen is pretty much what I had lined up, just because there's a really obvious example at the moment, because it's quite a good range trading scenario. So I'll start with that. So here is our LCG trader platform. Euro sterling, yep, can certainly have a look at that, Marcus, as well. Yep, for sure. So so obviously I've highlighted these couple of examples already, and what I'm going to try and do is, again, allude to that idea that you know, one piece of technical analysis by itself does offer some sort of edge, but really ideally you want to be combining it with some other tools. So it's a balance to strike here, you know, and obviously these tools put together are what give you your trading edge and what give you a chance of beating the market. But the trick is to have not too many tools where you get overwhelmed, but enough that can kind of complement each other to increase the probability of the trade that you're looking at. So if I zoom this chart out a bit, what I'm doing here makes a bit more sense. You know, we've been in a big range trading scenario in dollar yen for a while now. So at this period of time, we've been trending lower. We came right up to this previous high, almost got to it, dipped down again, and then we could see that actually we'd gone from a very kind of slightly more aggressive downtrend to more of a kind of loftier, you know, when we couldn't even put a lower low in down here. Again, we're analyzing the trend. We're thinking, hold on, there wasn't a lower low. Prices have got all the way up to the high, you know, actually maybe this previous high, given the fact that we're now maybe in more of a range trading scenario than a trending scenario. Obviously we don't have to be. The price could rip off and into a new uptrend up here, but actually given the way the price action's looking, good odds that maybe it's turning into a range. So the old high is always a level to look at, but then one way to do it is just place an order at the old high, but you can look at, for example, a shooting star appearing like this. And in this example, we saw a little pullback in the original candlestick. Then we saw a push above the old high, basically a fake out a false breakout, and prices rolled over and closed lower. So you know, it's a nice little example of a reversal pattern there. And if you follow the price down, you can see a lot of these patterns start to emerge. My old boss was a real stickler in terms of definition of an engulfing pattern, that it's only an engulfing pattern if it happens at the end of a trend. I think that probably is true in terms of strict definition, but in terms of using it, I think there's still a lot of application to be had with bearish engulfing patterns throughout a trend. So you'll notice here, we hit that resistance, but we were in an uptrend, right? We pulled back to these old lows here, so that was the high. So it's kind of classic looking trend scenario. So here we're kind of combining, again, support and resistance and trend analysis, where we're trending higher in this kind of shorter term basis. You know, we're making newer highs, higher highs, higher lows, breakout, pull back to the old high, rally up, natural enough, right? Pull back down to that previous resistance, turn support again, and that's when you see this kind of spinning top candlestick pattern here, where basically, again, it's a sign of uncertainty because the price has rolled over quite dramatically, yet we were in an uptrend. So who takes over? No one really knows until the next period when you get a pretty good clue of who's taking control. Can I move that? Ooh. Go on, let me move it. Anyway, I think you know what I'm talking about. This pattern right here is the bearish engulfing pattern. Bearish engulfing takes us right through the support, and there you are. There's an indication that actually this uptrend has ended, this longer term resistance has taken over, and now we're into a new downtrending environment. So there are different ways you could enter this trade. Now with the benefit of hindsight, actually all of them were open. That's not always the case. If I get that thing out of the way for the time being. So you can enter the trade right at the close. Now that is an option that will guarantee you a position based on this candlestick chart, but the downside is that you're selling right at the end of a large bearish engulfing large bearish candlestick. So obviously you're kind of selling at the low, if you like, which is never especially ideal. But obviously you would do so in expectation that it's the low of that period, but other periods are going to close lower. The alternative is that you wait for a pullback to the to either a 50% retracement of that candle or a previous support level that had been taken out. So this was our support that we have in here. You can see that actually if you had just waited and entered your trade in here with perhaps a stop loss above the old high of the engulfing candlestick, popped above the resistance a little bit, but then rolled straight over. And actually what did it produce? If you'd wait till the close of the candle, it was actually quite a nice little kind of long wick, right? It's not really a shooting star, but it's a shooting star type looking pattern, which shows that bulls tried to take over, selling the price at the high, but eventually it rolled over to the lows. So that was that very clear-cut example. Now we find ourselves obviously pretty much at the same thing happening again. So you know, this is an example of where I don't know why I can't drag this for something. It's literally is going a bit mad at the moment. Normally you can drag these boxes around, but at the moment I'm doing this kind of bizarre operation. Oh, there we go. There we go. So here, again, a nice little example of a shooting star pattern at the old resistance, which has already worked. Now, here, now one thing I wanted to point out is that you get these little tiny periods. These are Sundays, so don't take engulfing candlestick patterns based on a Sunday, because that's not really a kind of proper period. It's only like opens at 10 o'clock and the period closes at 12 o'clock. It's not a proper day. So that, even though it looks like a bearish engulfing pattern, isn't. But obviously these things aren't perfect. So it comes nicely up to the resistance here, sells off. It's not the most clear-cut looking pattern, but it is a nice little false breakout of these previous highs and rolls over again. Market does turn low. If you sold at the close here, market was turning low. Would have been you'd be feeling good at that point that the trade's working out. Unfortunately, it's been the end of a big uptrend. That was only really the first test of the resistance. In this period, all you really needed was one, but that was when the resistance was a little bit more fresh. At this point, it's not as fresh. It's the second major test of this resistance. So again, we're applying the kind of support and resistance idea, some of the principles we talked about in the support and resistance webinar, where the second or third test of a support and resistance isn't necessarily as strong. It makes the resistance more significant, but it's not as strong. So here in this case, with the benefit of hindsight, we've learned that actually we needed to wait for the kind of second, almost third test for some signs of a top to be put in. And now we had an inside bar following that reversal. It's not the most convincing inside bar because the body is roughly the same size. Nonetheless, we had an inside pattern, and now we've broken below what was a pin bar, shooting star, and we've got the makings of, at the moment, we'll have to see how it ends up, of a potential bearish engulfing candlestick pattern here. But as I said, there are going to be examples where these patterns don't work. So the key is identifying where these patterns are taking place within the current trend. In this example, we're obviously looking at the end of a trend where the trend could reverse. The shorter term trend could reverse in the context of a larger range. But there are also examples where you're looking for the trend to continue. So again, maybe using some other form of analysis here, a bit of a trend line going through these highs. See the price rise up after hitting support down here, longer term support perhaps, excuse me, and then hits this rising trend line, false break. This red pattern here would actually be a potential sell signal, right? Because you're looking at these old highs here, and you see that you see this basically a kind of pin bar at a range. But you're slightly worried because price has pushed well beyond the declining trend line, but it closed back within it. That, to me, would be a fairly reasonable trade to actually try and sell at a resistance with a bearish reversal pattern. But as we see here, trades low, but then we get this epic-looking bullish engulfing pattern. So the nice thing about candles patterns is, obviously they don't work every time. Nothing does, right? But when you're wrong, because in this instance, you're looking at a bearish reversal pattern. The next period, you've got a massive bullish pattern. If you've got the sense of composure to get kicked out of your old trade, you were short, you had a stop loss above the high, for example, but then the high gets taken out, your stop gets kicked out, but you see emerging, okay, hold on, this trend line's broken now, we've hit that long-term support, big bullish engulfing pattern, let me get on the long side. Now again, things aren't always easy. If you'd waited for another pullback to the trend line or for a 50% pullback, missed out. Had you bought at the next open of the period, you'd be quids in for another nice little move higher. So it's all about kind of placing the context of these patterns, and obviously when they don't work out, which will happen all the time, it's not getting too upset about it, but learning from the fact that your trade got knocked out. What does that tell you about this? Was your entry just a bit early, or where is in fact the trend changing, and should you be looking for something on the other side of the trade? So I've kind of run through dollar yen a bit. Let me try and see if I can go to euro sterling. The other thing I wanted to talk about was use of indicators. So this is going to be a little bit on the fly. I don't actually have this chart loaded up yet. So euro sterling, I would say it really is a bit of a mess at the moment, euro sterling. Let me put my excuse me. Let's not have those moving averages distracting us. What am I doing? Beep. Beep. So, yes, so obviously in the case of euro sterling, if we look at a historical example, here we're looking at a very strong uptrending environment for euro sterling, right, on a kind of daily trade basis. Well, so I just had a question from Ateza about combining chart patterns in combination with candlestick patterns. You know what the funny thing is actually, that often when you're looking at a candlestick pattern on a longer term chart, actually what you're really looking at on a shorter term chart is a pattern. So look at this bad boy. Now that I mention it, right, what does this remind you of? If we drop down to an hourly time frame, am I going to be able to do that successfully? Let's have a look. Oh, that's a very slopey looking line. Have I gone too far? No, not far enough yet, right? Maybe I can do this. What's that pattern? Head and shoulders, right? Left shoulder, sort of double looking left shoulder, head, right shoulder, break of the neckline, retest of the neckline and down. So you look at an hourly chart, that is a head and shoulders pattern. And so you're looking on a daily chart, it's it's a few candlestick patterns. So certainly using them both together when they're pointing to in fact the same thing, it's just a confirmation of the idea working, right? But certainly combining patterns in general, either you're using these candlestick patterns in the context of a trend, or you're looking at some longer term reversal, signs that reversal is happening. So for example, here on this hourly chart, it's not my greatest example, but excuse me, here it's a double top, right? So you've made one high. We're at this long-term resistance, obviously. If someone had this long-term resistance in mind and they're looking at the hourly candlestick chart, this bearish engulfing candlestick pattern adds weight to the double top. In fact, it takes you right down through the kind of neckline, if you like, of the double top. So, with the benefit of with the benefit of hindsight, you can see why the market tanked after that, because it was that long-term resistance level and a nice little double top, and then on, back onto the daily time frame. Obviously, it was a shooting star as well. So, looking at all these things together, it's not about one particular pattern. It's like, what does it all mean? And if all of them pieced together, yeah, you get the point. And then question from Brian: does the engulfing handle have to cover the wicks or just the body? So what I was saying before is that it's ideal if it does cover the wicks, because it makes it a stronger pattern, but it actually doesn't have to. So obviously this one here that we're maybe looking at a bearish engulfing in dollar yen today, it's not as strong as it could be, because it's not covering the old high, but the body is covering. And given that we've already had like 3 false breakouts here, I would say it doesn't necessarily need to in this context. So again, adding a bit of context to it. So jumping back to euro sterling, what I was hoping to do is just give an example of candlestick patterns in combination with indicators. So obviously the immediate one to kind of look at in this example would be when the indicator starts getting overbought. So one thing that I'll You know, I'll try and touch on maybe in another webinar when we talk about oscillators, is that when it's a rising trend environment, you don't want to suddenly just sell the market when an oscillator's overbought in a rising trend. You know, you're basically going against the grain there. But one thing you do want to keep in mind is once the market's looking very overstretched, and then it gets to an overbought scenario and then comes out of the overbought scenario, then maybe you're looking at a change in context. And obviously this was a very extreme example. You obviously can get examples where it'll pop out of overbought and then pop again and make rising prices. But if you take the fact that it's come out of the overbought area here, so if I put a sort of vertical line through here when we know it's happened, what are we also seeing on the candlestick chart, right? Basically, well, it's a bit of a strange looking one because I think it was maybe a weekend, so you can see that actually there's a small gap basically where it kind of opens basically at the previous open rather than the previous close. I would assume that's maybe a Sunday, is it? 29th, that sounds about right. Anyway, whatever the case is, sometimes you get small gaps in Forex markets. But it's basically an engulfing pattern following a shooting star, right? So those things combine at a time when the indicator's coming out of overbought territory. You know, maybe that's not enough for you. Then you see another bearish engulfing candlestick happen here. So a couple of bearish engulfing candles in a row with the indicator now well out of its overbought territory. So again, these things aren't perfect. Maybe you're looking for the trend to continue. Again, you know, a lot of trading is just, you know, just having the strength of convictions to want to enter your trade. So, you know, maybe we're calling this like a little kind of area of resistance, kind of struggled around a bit, popped off it, rallied up, came back, and say we saw a bullish engulfing candlestick pattern here. Well, we had been rising for a long period of time. The indicator, the RSI, had basically come down to, you could say, well, close to the 50 level, right? So it comes down, finds support at the 50 level. You expect, like in these previous examples, you can kind of see here that sort of between the 55, 50 area in the RSI, that's offered support to the uptrend. So maybe you're expecting that to happen, you get the bullish engulfing, the next period you get the bearish engulfing and you're stopped out. Again, you know, this is going to happen, but you've got logic behind your trades and you're managing your risk. You've got a stop loss in place. There's a logic for why you're placing the trade. And again, in this example, man, this should have this should have bounced if the bounce should have carried on if this uptrend is going to continue. But it doesn't. You know, you get a bearish pattern, and that again combines when the RSI drops below the 50 mark, showing weakness in the trend. And so the oscillator information in combination with the candlestick pattern, in combination with the fact that, you know, the trend seems to be reversing in terms of highs and lows, maybe some kind of longer term support and resistance. Obviously in this case, yeah, we've hit that massive resistance level, the 93 in euro sterling. All of it adds together, right? The support and resistance, the trend, the oscillator, the candlestick patterns to add weight to your trade idea. So the market obviously falls off a cliff, but again, we kind of know why, right? Because all this information, again, with the benefit of hindsight, all this information was stacking up to show us to get on the short side. As we currently stand, we've seen a nice little bullish pattern recently. Now, obviously this this 87.50, I would call it, if you just you probably saw from my, if you watched my support and resistance webinar, you see that I tend to like try and round off to the 50 levels because they're really what the big players are paying attention to. Came down to the support. Oh, what's this little beast down here? Close to a doji, right? A spinning top slash a hammer, and following, the market shoots right up. That was a massive candle, and it was and you know, in the context of these falling highs, we've rolled over a bit since. Today you know, basically we're in a kind of trading range. So even though today looks like the makings of a kind of bullish engulfing pattern, you know, what is this area? Does this have any significance? I'm not seeing any particular reason why, you know, whatever yesterday's low was would be particularly significant. 87, 89, I guess we're not far away from the 88s. So that's kind of one reason why it's bounced, but in the context of this range, really for me it's the 87.50 that's capping the range, and that's where you're looking for, in a range you're looking for buys at the lows, sells at the highs. So even though it looks like the candlestick pattern's happening here, what other information do we have with it? To me, not necessarily so much. That's not to say it can't rally from here, but is it a high probability trade? Excuse me, probably not. So then where would the high probability trades be? Well, back just up the top of the range. Again, this range is not perfect. The kind of, we're making like higher, lower highs in a way. But a benchmark I'll generally use for ranges is that, say we're looking at, what are we looking at here? Sort of 90 down to 87.50. So a 250 pip range, right? You basically want to take a sort of 20% zone at the top and bottom of the range. So say it's a 200 pip range, 20% of it obviously is 40 pips. So you want to just kind of eye up 40 pips below, and that's actually what I've just drawn in here, right? I promise I didn't plan that, but that basically you can see that kind of is working out. Well, that was the high, and then you know you had another pattern off the high here, and then still within that kind of 20% range of the high, people are still willing to sell within there, and you know similar at the low. So you know by that same logic, you could probably say, well, 40 pips off the low here, but you know. That's kind of a range trading environment. For me, this chart looks a bit of a mess at the moment. I'd assume that we're going to get a continuation of this move down. You know, a dramatic move like that. You know, naturally to me, you know, maybe there's a bit of consolidation before we roll over and continue the trend is what I would expect. But we've got a pretty solid area of support here. So naturally, for me, I'd want to see that support being taken out before I get a bit more keen on taking the market to the short side. And you know, if that can come in combination with a bearish continuation candlestick pattern as we take out that low, you know, all the better. So we've been going at it a while now, so I'll jump over. Everyone's been a bit keen on currencies today, so I'm going to jump over to the pound, and we'll probably round off there. The cable chart, obviously. Do I have that already up? No. Now, obviously, you've seen that me defaulting towards the daily candlestick chart. That's just typically the time frame that I operate from, because obviously as an analyst, the job is covering lots of markets. I can't cover the 5-minute time frame on every market, right? I've got to scale it up a bit to the daily time frame, weekly time frame. If you guys are just day trading, you know, the pound as we're looking at the moment, you know, looking at 15, 30-minute charts, these patterns apply just as well, but it's the same as every technical indicator. The patterns occur more frequently on the shorter time frames and give you more trading opportunities, but they tend to be less reliable. So that's just the rule of thumb when you're picking your time frame. You know, you're probably going to get more false trades, maybe a higher percentage of your trades will be losers, but you'll get more trades. And it's not to say that you can't get some, you know, really big winners that give you an edge, give you a positive expectation on your short-term trading. That just tends to be how the results skew. You know, unless you're scalping, obviously, you're just taking some very small profits and occasionally get hit with a big loss. So yeah, in the case of sterling, I mean, you'll notice that it's the pound kind of driving both the cable chart and the euro sterling chart, because they're both a bit of a choppy mess, right? So maybe I can, yeah. I kind of want to use my template, but I don't want these moving averages here. Let's see. What piece of analysis did I say I was going to support and resistance, momentum, and trend identification? I mean, I've kind of used all of those. Trend identification, I guess you could maybe incorporate moving averages as well. You know, what do you learn from this cable trend at the moment? There is no trend, right? It's basically going sideways. The price is going up and down through the 20-day moving average. Basically tells us there's no trend. Here's the nearby support. Here's the nearby resistance. Again, maybe applying kind of zones to those. We've maybe got the first signs that this market's about to roll over. We have like a hanging man pattern here at the 20-day moving average, but it's right in the middle of the zone, so it's not, you know, it's not overly reliable. But you can see basically that's in the middle, right? And it's the where the 20-day is. If this continues and we get a break of the support, then to me it looks more ominous for cable, and we start targeting the you know, the next major support down here at 127-ish, maybe 28. But at the moment it's range trading. There was no particularly great candlestick pattern. This was like a dark cloud cover at the top here. It's not something I covered just because I don't think they're like overly reliable. You see them all the time basically. It's where it doesn't engulf the entire previous candle. It engulfs like 50-70% of it. And then obviously we just tanked all the way to the bottom in one candlestick, so not too much use to be had from that. It was the lowest close for a while, so maybe what we're dealing with at the moment is that we had a strong kind of bearish engulfing candlestick. Again, it opened at the previous close. It was a previous down candlestick, so you can call it bearish, but engulfing. But really there wasn't much of a previous candlestick to engulf, and you know, we took out those previous. Yeah, you know, it's the lowest close. This one had the close down here, and then we had you know, see how the close of the candlestick is actually what people were buying into in this particular pattern here, which again was maybe you could consider a bit of a hammer at the low. So we've taken out the bottom of that. We closed lower than that hammer. Now we're pulling back to the moving average, maybe about 50% of the drop, and then maybe we're building up to taking out the support. It looks a bit like that at the moment, but no real confirmation of such. And then the other piece of the pie, I suppose, is the oscillator, where we came out of an overbought situation and we rolled over, and so far we haven't entered oversold yet. So in a kind of greater scheme of things, we're kind of holding on to a kind of bullish zone in the indicator, where you can see that throughout this rising trend environment. Not wait in mind. Well, again, I guess that's worth adding onto the chart as well, isn't it? The if we break this candlestick, obviously adds a bit of extra weight to the significance of the situation. But for the moment, while this rising trend has been taking place, we haven't really got into oversold territory, but we have got overbought a few times. So that's how the trend has kind of maintained itself. But if we do dip into you know, below the 30 level, and we get some kind of bearish looking candlestick patterns, and we reverse the trend line, then actually the pound is not looking so good. At the moment, maybe I'll just assume the trend is going to continue, but it's showing signs of reversing. So we've pretty much hit the hour mark for the entire webinar here, just a bit shy of. So I'm probably going to call it a day there. Obviously, if you haven't done so already, feel free to open a trading account, demo or live with LCG. in which you can use this LCG trader yourself. Thank you very much for attending, everyone, today. I really appreciate your input, the ideas on the charts. I hope you gained a bit of an understanding, or at least a different take on how to use candlestick charts today. Good luck with trading for the rest of the week. Jasper signing out. Thanks a lot, everyone.